Options trading is often perceived as complex and high risk, especially for beginners. This introduction clarifies options by explaining their nature and functionality. The explanation includes how calls and puts operate and how traders utilize them. Beginners can learn how to start trading options safely and effectively. Options trading is often perceived as overly complex and reserved for professionals. This perception can deter individuals from exploring options as a viable investment strategy. However, with a solid understanding of options, they can be powerful tools for various investment goals. Therefore, dispelling misconceptions is crucial to unlocking the potential benefits of options trading. This video provides a step-by-step breakdown of options trading. The focus is on explaining the core fundamentals of options trading. The video aims to provide real education about options. Avoiding hype, it is designed to be informative rather than promoting gambling-like behavior. The objective is to equip viewers with a solid understanding of options trading principles. An option is a contract granting the buyer a specific right. This right allows the buyer to either buy or sell an underlying asset. The asset is transacted at a predetermined price, known as the strike price. The transaction must occur by a specific date, referred to as the expiration date. The option buyer has the right, but not the obligation, to exercise the contract. This means the buyer can choose whether or not to buy or sell the asset. An option does not represent ownership of the underlying stock. Instead, an option grants the purchaser the right, but not the obligation, to control the stock. This control is exercised within a specific time frame and at a predetermined price. The option buyer has the choice to buy or sell the underlying asset. The decision depends on whether it is a call, buy, or a put, sell option. This differs from stock ownership, where the buyer directly owns a portion of the company. Options trading enables investors to capitalize on price fluctuations in both directions. This means traders can profit whether the price of an asset increases or decreases. Options often require less upfront capital compared to directly purchasing shares. This lower capital requirement can make options trading more accessible. Therefore, options provide a flexible and potentially more affordable way to engage in financial markets. A call option is a financial contract that gives the buyer the right, but not the obligation, to buy an asset at a specified price within a specific time period. Call options are typically purchased when a trader anticipates that the price of the underlying asset, such as a stock, will increase. The buyer profits if the asset's market price rises above the option's strike price before expiration. The potential profit is theoretically unlimited, as the asset price can rise indefinitely. However, the buyer risks losing the premium paid for the option if the asset price does not rise as expected. A call option's value is directly correlated to the underlying stock price. When the stock price increases, the value of the call option also increases. This is because the call option gives the holder the right to buy the stock at a specific price. If the stock price rises above this price, the call option becomes more valuable. Therefore, the potential profit from exercising the call option increases as the stock price rises. A call option's concept is visually represented using a price chart. The chart displays an upward movement, symbolizing a potential increase in price. The term call is highlighted on the chart to emphasize the option type. This visual aid helps in understanding the potential profit from a call option. A put option is a financial contract that gives the buyer the right, but not the obligation, to sell an asset at a specified price. This right extends until a predetermined expiration date. Investors typically purchase put options when they anticipate a decline in the asset's price. The option becomes profitable if the asset's market price falls below the option's strike price before expiration. Thus, a put option serves as a tool for speculation or hedging against potential losses. A put option's value is inversely related to the underlying stock's price. When the stock price decreases, the value of the put option increases. This increase in value occurs because the option grants the right to sell at a higher price. Thus, a put option benefits from a decline in the stock's market value. A put option is visually represented using a price chart. The price chart moves downwards to signify the nature of a put option. The term PUT is highlighted to emphasize the concept. This visual aid helps in understanding the potential profit from a decline in price. Options trading is built upon the fundamental understanding of calls and puts. Mastering these concepts is essential for navigating the complexities of options. Calls and puts are the basic building blocks of more advanced option strategies. A call option gives the buyer the right, but not the obligation, to buy an asset at a specified price. A put option gives the buyer the right, but not the obligation, to sell an asset at a specified price. Therefore, A solid grasp of calls and puts is crucial for successful options trading. The strike price is a critical factor in options trading. It represents the predetermined price at which the underlying asset can be bought or sold. For a call option, the strike price is the price at which the holder can buy the stock. The option gains intrinsic value only when the market price of the stock reaches or exceeds the strike price. The expiration date marks the termination of an option contract's validity. It is the specific date on which the option holder's rights cease to exist. After the expiration date, the option can no longer be exercised. Therefore, the expiration date is a critical factor in an option's value and trading strategy. An option chain is a listing of all available option contracts for a specific security. It organizes options by strike price and expiration date. Strike prices represent the price at which the underlying asset can be bought or sold. Expiration dates indicate the last day an option contract is valid. Visualization tools highlight these key components for easy analysis. This allows traders to quickly assess potential profit and risk. Time decay affects option values as the expiration date nears. The rate of value loss accelerates closer to expiration. This acceleration occurs if the underlying stock price does not move favorably for the option holder. Unfavorable price movement combined with approaching expiration significantly erodes the option's value. Timing plays a crucial role in options trading strategies. The value of an option is significantly affected by time decay. Time decay refers to the gradual erosion of an option's value as it approaches its expiration date. This erosion occurs because there is less time remaining for the underlying asset to move favorably. Therefore, understanding and anticipating time decay is essential for successful options trading. Strategic timing can maximize profits and minimize losses in options positions. Options are leveraged instruments in financial markets. Leverage amplifies the potential gains from a relatively small initial investment. Due to leverage, options prices can change more rapidly than the underlying stocks. This increased volatility presents both opportunities and risks for traders. Understanding leverage is crucial for effectively trading options. Options trading provides leverage, amplifying potential gains. Small price changes in the underlying stock significantly impact option values. This leverage allows traders to control a large asset position with a smaller capital outlay. Consequently, profits can be substantially higher compared to direct stock ownership. However, it's crucial to remember that leverage also magnifies potential losses. Options trading involves leverage, which can amplify both gains and losses. Due to leverage, even minor price fluctuations can result in substantial losses. The potential for significant losses is a key risk factor in options trading. Traders must be aware of the magnified impact of price movements on their positions. Effective risk management is crucial to mitigate potential losses from leveraged positions. Beginners should prioritize risk management when using leverage. Small position sizes are crucial for managing leverage-related risks. Smaller positions limit potential losses from market fluctuations. This approach helps beginners learn without risking substantial capital. Conservative position sizing is a fundamental risk management strategy. Options should be regarded as instruments for strategic trading. They are not intended as speculative investments for rapid gain. The value of options lies in their utility as tools. Options facilitate diverse trading strategies and risk management techniques. Professional traders employ systematic methods when trading options. Their approach is structured, avoiding random or impulsive decisions. This contrasts with amateur traders who may act on hunches. A structured approach involves predefined criteria for entry and exit. Risk management is a key component of this structured approach. Professional traders prioritize disciplined execution of their strategies. Chart analysis is a fundamental practice for traders. Traders begin by examining the chart to interpret the price action of the underlying stock. Understanding price action is crucial for informed trading decisions. This analysis helps in identifying potential trading opportunities. Trend identification is a critical step in options trading. Identifying the prevailing trend helps in making informed trading decisions. The two primary trends to identify are uptrends and downtrends. An uptrend indicates that the price of an asset is generally increasing over time. A downtrend indicates that the price of an asset is generally decreasing over time. Accurate trend identification is essential for successful options trading strategies. Support and resistance levels are key concepts in technical analysis. Identifying these levels assists traders in making informed decisions. Support levels indicate price levels where a downtrend is expected to pause due to a concentration of buyers. Resistance levels, conversely, suggest price levels where an uptrend might halt because of selling interest. Marking these levels on a chart helps visualize potential entry points for buying or selling. They also highlight possible exit points to secure profits or limit losses. Confirmation signals are indicators traders use to validate potential trade setups. These signals help traders assess the likelihood of a trade being successful. Traders typically wait for these signals before committing to a trade. This practice aims to increase the probability of profitable outcomes. Traders analyze charts to predict future price movements. Based on this analysis, traders decide whether the price will go up or down. If the expectation is an upward price movement, a call option is selected. Conversely, a put option is chosen if a downward price movement is anticipated. The trader's decision-making process involves evaluating support and rejection levels. Support levels indicate potential buying opportunities. Rejection levels suggest potential selling opportunities. Option entry points are determined based on these levels. A chart visually represents these decision points. This visual aid helps traders make informed decisions. Option prices are directly correlated to the price of their underlying stock. When the underlying stock price increases, the value of call options typically increases. Conversely, a rise in the underlying stock price usually leads to a decrease in the value of put options. Conversely, when the underlying stock price decreases, the value of put options typically increases. Conversely, a decrease in the underlying stock price usually leads to a decrease in the value of call options. Chart analysis should always be the primary step in options trading. Trading decisions should be based on thorough chart analysis. Chart analysis provides essential context for market condition. It helps in identifying potential trading opportunities. Therefore, prioritize chart analysis before making any options trading decisions. The market exhibits an uptrend when prices generally move upwards. An uptrend signifies a sustained period of increasing prices. This trend indicates positive market sentiment and buying pressure. Traders and investors often seek to capitalize on uptrends. A price pullback occurs when the price of an asset temporarily declines. This decline often retraces a portion of a prior upward price movement. The price pullback moves towards a support level. A support level is a price point where a stock's price tends to stop falling. At this level, buying interest is strong enough to prevent further price decreases. Buyers are likely to step in and purchase the asset at the support level. Buyer intervention occurs when buyers actively participate in the market. This intervention typically happens at a support level, indicating a price point where buying interest is strong. The presence of buyers at the support level suggests renewed upward momentum. This buying activity can halt a price decline and potentially reverse the trend. A call option provides the holder with the right, but not the obligation, to buy an asset at a specified price. Purchasing a call option is a strategic move when a trader anticipates an upward price movement in the underlying asset. The trader believes the asset's price will rise above the option's strike price before expiration. This allows the trader to profit from the difference between the market price and the strike price. The potential profit is theoretically unlimited, as the asset's price could rise indefinitely. Call options require sufficient time before expiration. This allows the underlying asset's price to move favorably. Adequate time increases the probability of the option becoming profitable. Insufficient time may result in the option expiring worthless. Therefore, expiration timing is a critical factor in call option trading. Selecting a reasonable strike price is crucial. The strike price should align with the anticipated price movement of the underlying asset. Careful consideration of expected price fluctuations is necessary. An appropriate strike price reflects informed market analysis. This selection directly impacts the potential profitability of the option. A stop-loss order is a tool used in trading to manage risk. It is designed to limit potential losses on a trade. The order is automatically triggered if the price reaches a specified level. This helps to prevent significant financial setbacks if the market moves unfavorably. A profit target is established to specify the intended profit margin for a trade. Setting a profit target involves determining the desired level of financial gain. This target acts as a benchmark for evaluating the success of the trade. The profit target guides decision-making throughout the trading process. It helps traders define when to close a position and realize profits. Effective profit target setting is crucial for achieving financial objectives in trading. Emotional discipline is critical for successful trading. Setting stop-loss orders helps to limit potential losses. Profit targets define the desired outcome for each trade. These preset parameters reduce the impact of fear and greed. By adhering to these rules, trading decisions become more objective. Beginners commonly purchase out-of-the-money options. Out-of-the-money options are those with a strike price far from the current asset price. These options have a low likelihood of becoming becoming profitable before expiration. The appeal lies in their relatively low cost compared to in-the-money options. However, the potential for significant loss is high due to their low probability of success. Trading without chart confirmation elevates the potential for financial losses. Chart confirmation involves analyzing price charts and technical indicators. This analysis helps traders assess market trends and potential entry exit points. Skipping this step means making decisions without a clear understanding of market dynamics. Without chart confirmation, trades are based on speculation rather than informed analysis. This increases the likelihood of misjudging market movements and incurring losses. Holding options for extended periods introduces the risk of time decay. Time decay erodes an option's value as its expiration date approaches. This erosion occurs because the time value component diminishes. The time value reflects the potential for the underlying asset to move favorably before expiration. As time passes, this potential decreases, reducing the option's price. Consequently, holding options too long can lead to financial losses, even if the underlying asset moves in the anticipated direction. Excessive risk-taking in a single trade can lead to rapid depletion of trading capital. Allocating too much capital to one trade increases the potential for significant losses. Such losses can quickly erode the account balance, potentially wiping it out entirely. Proper risk management is crucial to protect trading capital and ensure long-term viability. Options trading necessitates a disciplined approach. Patience is a key virtue for success in options trading. Impatience can lead to unfavorable outcomes in options trading. Options trading strategies often require time to mature. Premature actions driven by impatience can erode potential profits. Discipline and patience are crucial for navigating the complexities of options trading. Small, controlled trades are crucial for survival in options trading. These trades allow for careful risk management and capital preservation. They help traders avoid large, potentially devastating losses. Controlled trades enable traders to learn and adapt to market conditions gradually. This approach fosters a sustainable and profitable trading strategy over time. New traders should begin with exchange-traded funds, ETFs, to minimize risk. ETFs like SPY and QQQ are suitable starting points due to their diversified nature. SPY tracks the S&P 500, representing a broad segment of the U.S. stock market. QQQ focuses on the NASDAQ 100, comprising leading technology and growth companies. Compared to individual stocks, these ETFs exhibit lower volatility. Lower volatility reduces the potential for significant losses during initial trading experiences. Longer expiration dates provide traders with an extended time frame for their positions to become profitable. This increased time horizon allows for greater flexibility in managing trades. The market may fluctuate, and a longer expiration date gives the trade room to recover from temporary downturns. Traders are not forced to close positions prematurely due to time constraints. This can lead to a higher probability of realizing the intended profit target. Therefore, longer expiration dates can be advantageous for certain trading strategies. Effective risk management is crucial for capital preservation. Only allocate capital that you are comfortable potentially losing. This approach protects against catastrophic financial setbacks. Understanding your risk tolerance is essential. Avoid risking essential capital needed for basic needs or operations. Prioritize the protection of your capital base above potential gains. Paper trading allows individuals to practice trading strategies without using real capital. This practice helps in gaining experience in market dynamics and trading mechanics. Paper trading builds confidence by simulating real-world trading scenarios. It minimizes financial risk while learning to navigate the complexities of the stock market. Paper trading platforms simulate real trading conditions without risking actual capital. These platforms allow users to practice buying and selling securities using virtual money. Users can experiment with different trading strategies and investment approaches. Paper trading helps familiarize users with platform tools and market dynamics before real trading. Consistent practice is a cornerstone of developing proficiency in trading. Through practice, traders refine their skills in market analysis and decision-making. Increased skill and experience lead to greater confidence in one's trading abilities. This confidence is essential for executing trades effectively and managing risk. Confidence is a key element in developing trading discipline. Discipline enables traders to consistently adhere to their established trading plan. Following a trading plan is crucial for managing risk and maximizing potential profits. Therefore, Confidence indirectly supports successful trading outcomes through disciplined execution. Options trading is not a shortcut to instant wealth. Success in options trading demands a specific skill set. Effective options trading requires disciplined execution. Options trading involves strategic decision-making and risk management. Options trading is not a get-rich-quick scheme. Achieving success in options trading requires a significant investment of time. It also demands dedicated effort to acquire the necessary knowledge and skills. Consistent learning is essential for understanding options trading strategies. Patience and persistence are key to mastering the complexities of options trading. Options trading provides increased flexibility in financial markets. This flexibility enables traders to adapt to varying market conditions. Options allow for strategies that can profit in rising, falling, or stable markets. Unlike some instruments, options are not limited to profiting from price increases alone. This adaptability is a key advantage for managing risk and maximizing potential returns. Traders can use options to hedge positions or speculate on future price movements with greater precision. Options trading provides opportunities for profit regardless of market direction. This includes upward trending markets, where prices are generally increasing. Profit is also possible in downward trending markets, characterized by declining prices. Even in sideways or range-bound markets, option strategies can be employed for gains. Options offer flexibility through various strategies to capitalize on different market conditions. Understanding these strategies is crucial for maximizing profit potential in any market environment. Options trading provides tools for efficient capital management. Options enable control over a substantial number of shares. This control is achieved with a relatively smaller capital outlay compared to direct stock purchase. Options can enhance capital efficiency in investment strategies. Discipline is critical for success in options trading. Adhering to a well-defined trading plan is essential. A trading plan outlines specific entry and exit strategies. Effective risk management is a cornerstone of disciplined trading. Risk management involves setting stop-loss orders and position sizing. Maintaining discipline helps avoid impulsive decisions driven by emotion. Options trading is not about making random guesses about market direction. Successful options trading involves careful chart analysis. Chart analysis helps to identify potential trading opportunities. Effective risk management is essential for protecting capital. Options trading combines analysis and risk control, not guesswork. Proficient chart interpretation is essential for traders. Charts provide visual representations of market data. Analyzing chart patterns helps identify potential trading opportunities. Understanding chart elements aids in assessing market trends. Accurate chart analysis is crucial for informed trading decisions. Effective risk management is crucial for preserving capital. It is a key strategy for maintaining long-term viability in any venture. Understanding and mitigating risks helps prevent significant losses. Therefore, managing risk is essential for continued participation and success. Emotional control is crucial for sound decision-making in trading. Uncontrolled emotions can lead to impulsive and irrational trading behaviors. Rational trading decisions are based on analysis and strategy, not feelings. Mastering emotional regulation helps prevent costly mistakes driven by fear or greed. Therefore, emotional discipline is a key component of successful trading. Treating options like gambling can lead to negative consequences in the market. The market will penalize those who approach options trading with a gambling mindset. Options trading requires a strategic and informed approach, not random chance. Understanding risk management is crucial to avoid being punished by the market. Options can be a powerful tool when used strategically. Treating options as a business tool enhances their effectiveness. Mastering options can become a valuable skill. Strategic use of options can lead to significant advantages. Understanding options is key to leveraging their potential. The message prompts viewers to follow the channel. The channel provides real trading education. The channel offers trading tips. Following the channel gives access to educational content. Following the channel provides access to trading advice. The channel aims to improve viewers' trading knowledge and skills. Candlestick charts are utilized to visualize price movements over a specific period. These charts provide a detailed representation of opening, closing, high, and low prices. The body of the candlestick indicates the range between the open and close prices. Wicks or shadows extending from the body represent the high and low prices within the period. TradingView style candlestick charts are commonly used for their clear and informative display. Support and resistance levels are key concepts in technical analysis. Support levels indicate price levels where a downtrend is expected to pause due to a concentration of buyers. At support levels, buyers are willing to purchase the asset, preventing further price declines. Resistance levels, conversely, are price levels, where an uptrend is expected to pause due to a concentration of sellers. At resistance levels, sellers are inclined to sell the asset, hindering further price increases. Identifying these levels on a chart helps traders anticipate potential price movements and make informed decisions. An option chain displays all available option contracts for a specific underlying asset. It organizes options by strike price, showing both calls and puts. Each row in the chain represents a different strike price. Expiration dates are also clearly listed, indicating when the options expire. Visualizing the option chain helps traders analyze potential strategies. Call options give the holder the right to buy an asset at a specified price. PUT options give the holder the right to sell an asset at a specified price. Visual overlays can represent call options. Visual overlays can represent PUT options. These overlays help visually distinguish between option types. Price direction arrows are visual cues used to indicate market trends. These arrows provide a simple representation of price movement. An upward pointing arrow signifies an increasing price trend. Conversely, a downward pointing arrow indicates a decreasing price trend. The arrows offer a quick and intuitive understanding of market dynamics. They are commonly used in financial visualizations and trading platforms. Calm market footage can be used to create a professional atmosphere. The visuals should be subtle and not distracting. The background market footage should enhance the overall presentation. The market settings should evoke a sense of stability and reliability. The next step involves creating a video focused on beginner option strategies. The video's primary goal is to provide practical trading strategies for beginners. The content should be tailored to individuals with little to no prior experience in options trading. The video should clearly explain basic options, concepts, and terminology. It should demonstrate simple, low-risk strategies that are easy to understand and implement. The video should include real-world examples and case studies to illustrate the strategies in action. The next step involves creating a content calendar focused on options trading. This calendar should span a 30-day period to ensure consistent educational content. The primary goal is to provide ongoing education about options. A structured calendar helps in planning and delivering content systematically. Consistent delivery enhances user engagement and learning. This calendar will serve as a roadmap for educational content delivery.